Thank you very much. Let me come up to the stand here. I sort of find in my life, the only time I get listened to is when I stand somewhere like this. Two teenage boys, and I work and lead our sustainability business. And of course, the great thing about sustainability is everyone has a point of view, and they're very keen to share it with me. So thank you very much for joining late in the day. We are here to talk about the pivotal role that CFOs are going to play in our journey to net zero. And I'm joined by my esteemed colleagues from EY, and we've brought an integrated team across our sustainability offering, covering many different aspects, not just for CFOs, but of the broader journey. So we're Laurie Gawley, who works very much with our financial services clients. We've got Ben, who spends a lot of time with CFOs in particular and the finance function transformations. Michelle, who leads our EY law practice, looking at some of the legal implications from a compliance perspective. And Andrew, who's doing a lot of work around some of maybe the heavy lifting around data, systems, technology, and innovation. So hopefully with that broad coverage, we can have an interesting conversation. Just before we get to that, I just want to talk a little bit about some research that we have recently released. You can find it on our website. We're heavily involved in the Transition Plan Task Force. So for those who aren't aware, the Transition Plan Task Force was set up by the government, announced in COP26. And this is all around ensuring that companies in the UK have got detailed and well-planned net zero transition plans. The guidance is out, but it's not yet mandatory. But we did do some research. We looked across the FTSE 100 to see what's the state of transition planning in the UK and at that level. And this is the research. And you have to read into this that, as I said, they're not mandatory yet. So we probably shouldn't expect organizations to have fully developed and fully robust transition plans. But nonetheless, it's quite interesting to see just the state of where we are. So 95% of companies do have a net zero goal in place, which is fantastic. But as you can see, there only 22% have got what would be deemed a sort of credible transition plan. So there's a hell of a lot of work to do from a transition plan perspective. And one of the key areas that needs focus is around financial planning. And I think that's where the role of the CFO comes in. 79% of companies we went through the FTSE 100 have got big gaps on financial planning, and the framework there is on the right-hand side. Don't worry, I'm not going to go through the framework, but I do love frameworks, so I had to have it up there on the slide. But you can see the two red boxes there just on the second pillar around financial planning and sensitivity analysis. And I think as we move from sort of ambition to action, and we get into the detail of what's going to have to be done in our organizations, the role of the CFO is going to be absolutely pivotal for many reasons. And that's what we thought we'd discuss today with the panel. So let me go and join them. Ben, why don't you kick us off? So I've sort of teed up that the role of the CFO is quite important, but they're actually getting it from lots of directions at the moment, aren't they? And from a sustainability perspective and net zero perspective, sort of transforming their role.
Yeah, so let me talk a little bit about the role of the CFO and why it's critically important. I was talking last week to the CFO of a FTSE 100 retailer who was musing that back in 2019, this was definitely somebody else's problem. And in 2023, it seems to be alarmingly his problem in terms of how to deal with some of these issues. And it's way, way beyond the who's going to pay for all this. So if you think of what the CFO does, the Chief Financial Officer, the Finance Director, what does that person do, he or she? Well, there's a strategic role to this, which is firstly making sure the business is adequately funded. So you've got relationships with your providers of debt, relationships with your investors, and that functions efficiently, and the proper valuation of the business is reflected in the share price. So big job of the CFO up there. Similarly, a more internally focused role, but equally strategic, is making sure that the business allocates resources to the right things, plans its business effectively, drives the right performance, and traditionally drives a return, financial return for shareholders. So again, super important, massive role for the CFO. And then more operationally, you've got to make sure that your finance processes work, your controls are in place, and your organisation is fit for purpose. And finally, the thing you can never get away from, death and taxes, you've got to make sure that you deal with your regulators, be they tax authorities, be they people about reporting standards and what you report and what you disclose every quarter at the end of the year. So it's a pretty big role. And ESG or sustainability has started to drive a bit of a cart and horses through this. So firstly, back to regulation, it's an exponential increase in what needs to be disclosed, and what's being disclosed needs to be disclosed alongside the financial information. So it's a natural home for finance to be understanding what that regulatory environment looks like and getting clarity about what they need to disclose and what they don't need to disclose and what the standards are that go with it. So critically important, and certainly something you don't want to delegate to another part of the organisation. In terms of the investors, I think there's a growing understanding, and Laurie's much more of an authority than me on this topic, but understanding the decision making in your investor stack around who they will provide capital to, who they won't provide capital to, and who they won't. ESG and sustainability is an increasingly important dimension in that decision making in the capital markets. And as a finance director, if you don't understand that, you're in a lot of trouble in terms of funding the business. And then the decision-making part of the thing I think is really fascinating. We are used to making decisions based on return on capital employed, based on is this profitable for our business? It's financial measures. But you're suddenly being asked to make decisions about is this good for our environment? Is this good for society? Is it good for a range of different measures? And you've got to try and get those measures alongside the financial measures that we've been looking at for 100 to 200 years, if you like. And then finally, if you look at the plumbing, processes, systems, data, all of that, traditionally the CFO, the finance function, has got a critical role to play in managing that and curating that creation of high quality data. Well, guess what? You've got a whole load of new data turning up, which needs to be curated, looked after and controlled. So whichever way you look, this role of sustainability cannot be someone else's problem. The CFO and his team need to lean in hard, if you like. That's what we're seeing.
Yeah, I have a little fun with my clients, CFO clients, saying you can run but you can't hide, because exactly to your point, the finance is the finance functions typically are the holder of integrity, the holder of integral data, and whilst some finance teams maybe don't want to take the additional scope that some of this ESG and reporting brings, it's sort of coming in their direction. And will we see the change from chief finance officer to a chief performance officer as the financial and non-financial becomes even more integrated? But with that, let's just move on a little bit to some of these quadrants. And I'd love to pick up, Laurie, just on the investors and what's happening within financial services. I often get asked a lot, are they serious? Are the investors serious about this? And what change have we seen? Are we really seeing change? And in terms of what you're seeing, I suppose, around that seriousness, and what are investors now expecting and asking, particularly of CFOs?
Good question. So I think, firstly and foremostly, when you look at the financial service sector, the capital markets, you could argue that that market probably is impacted by sustainability matters, ESG related across any of those thematic areas, faster than your retail FTSE 10, FTSE 100 company. So I think from a capital markets perspective, first of all, they are the bellwether. Secondly, do they take it seriously? Yes. Now, I don't say absolutely yes, but I say yes. And if we go back to your TPT slide, the Transition Plan Task Force slide, one of the great things that we in the UK have done, albeit with a Canadian accent, I say we in the UK have done is we've led the TPT development and integration in the market hand in glove with government. So you'll see the largest FTSE 100 asset managers, asset owners driving it from the bottom-up market. So that action, converting the ambition to action, is crucially important. So they're leading by example. That would be my second point. Third point would be what we're seeing now, certainly from the asset managers, is they're responding not only to top-down regulation, they're also responding to investment mandates from their clients, being the pension funds. And increasingly, we're seeing asset owners, insurance companies, and so forth adopt exclusions for assets under management. So, for example, large actives are unable to bid for capital if they don't satisfy X, Y, and Z from a thematic area such as climate, nature, and social, as an example. And so that accessibility to capital then becomes the CFO's problem or opportunity. So it's really important, at least from my perspective, that the CFO understands their assets under management and who their institutional investors are and what the investors expect from them, because my hypotheses will be that no two investors are the same. They all have different thematic areas of interest, whether it be climate, nature, social, etc. And to, as a CFO and the front line to any institutional investor dialogue, you need to know what those thematic areas are to, one, preserve capital, but then two, to then generate capital, because as we know, the transition plans are capital heavy. So there was a CEO few weeks ago now who suggested that the capital requirements that they have in a heavy emitting industrial FTSE 100 was the equivalent of 10 years of capital that they had generated or asked for from the market. So that's 1 year capital requirements to achieve the climate change and climate adaptation requirements. So there's a significant amount of capital required. So with that, I would say that from a CFO perspective, they absolutely, without a doubt, need to know their institutional investors' priorities, not just on disclosures, but also engagement and also expectations for today, but in a 3, 5, 10-year period.
So I might come to you in a second around the narrative that has to go with that and the changing narrative around value. But just a question, Laurie. I mean, I suppose most CFOs would know their investor. They would say, well, I know my investors. But are you seeing that the questions coming from investors are different, therefore they're having to respond and expand maybe the scope of what they're discussing? Is that the big impact on the CFO?
So I would suggest that the CFO's IR function, investor relations, knows their current stack. So they will know the direct material investors that invest in any company. Perhaps where the opportunity for further knowledge or the blind spot is around the client of the institutional investor. So where the capital flow is coming from the owner, the manager, to the real world economy, and what the runners and riders are from a thematic area of focus on a quarterly, biannually, and annual basis, because it's not just climate. For example, we were in this workshop a month or so ago, and EY facilitated an institutional investors to come in, represented 15% of the stack of this FTSE 10, and the direct conversation was, your balance sheet is on loan from me. In order of priority, I expect you to sort out your circularity, improve your nature positive impact and outcomes, and sort out the social elements of human rights. There was no mention as a priority around climate, because for this company, the business model is reliant heavily on nature, circularity, and social. So just as an example.
So you're getting super clear around what those investor requirements are. In terms, I suppose, my CFO, definitely in my business, my CFO is pretty hard to get money out of. There's a load of investments coming this way, and we've got to make sure that we're very clear around the value that we make from those investments in achieving net zero. Andrew, what are you seeing in terms of that narrative and how we're getting that value narrative right?
Yeah, can you hear me okay? Yep. So I think there's basically two major challenges I see around that value narrative that the CFO is going to drive. If you think the CFO is really the CFO office of the future is really the transformation office. They're going to fuel, as we've talked about, they're going to fuel the investment needed to drive the transition to net zero, but the broader ESG agenda of any organizations. And there's two challenges to that. One is how do you demonstrate the value externally? So that outside-in analysis, that external narrative, and you see a lot of that criticism of a number of companies around the investment they've made. How is that manifesting itself in business performance, either financial performance, growth, etc.? And so that the ability to commercialize that sustainability agenda, that strategy into a value narrative is really going to be the one of the major challenges from a CFO perspective. One good example of that is one of the global energy management industrial automation companies that in about 2019 sort of pivoted their entire business around how they were a B2B, how were they driving sustainability or a sustainable business for their clients. And they were able to demonstrate that 70% of their sales were in green products. And then they were able to calculate the decarbonization impact that would have. And they basically put out 120 million tons of carbon decarbonization, carbon emission savings. And essentially from there, if you read all the analyst reports that year, they started off with that ESG strategy. And if you look at the share price of that particular organization, it's grown by 60% in the last 3 years. And that is that long-term value statement of how they pivoted their organization around the sustainability agenda, but turned it into a growth driver, is a great example of turning that investment around and that external perspective. The other side is the internal perspective, which is what Rob was sort of suggesting earlier, was around in order to drive net zero transformation for a multinational organization, across multiple countries, multiple business units, multiple functions, you're going to have hundreds of individual projects and initiatives. Most organizations today, and I'd be interested to see sort of show of hands in the room, are doing that on Excel, right? Now, how you roll that up, how can you possibly understand the CapEx, OpEx, return on investment of all those initiatives across business units, geographies, and understand the real return on investment and the trend and the forecast, particularly as the business is growing, you're rebaselining your carbon position. And that also goes for your social and governance initiatives as well. How do you quantify the value of those and look at the return on investment? And what you're seeing a lot of organizations do now is we're starting to look at what is that sustainability platform? How do we democratize all of those and those hundreds of initiatives that roll up into the overall net zero 2030, 2040 targets we've set? How do we then have those on a single platform, cross business units, cross geographies, so that we can the CFO and the finance owners can understand where they should be investing and what the real return on investment is from that. So you're seeing a pivotal change. So two massive big challenges that are going to need a sort of data and analytics and performance management around that external value narrative. How do we turn all that investment into a growth story for our investors and key stakeholders? And the second is, how do we monetize or commercialize all those individual projects across E, S, and G to understand where we should be investing to really drive that value narrative?
So why don't we move on to the next quadrant on our little model here? And I'm really conscious this is innovate net zero. This is all about positivity and innovation and how we're going to fix this challenge. But we're going to have to talk, a little bit about some of the regulation and compliance. And we talk a lot about the alphabet soup of different frameworks that everyone has to comply with, and the more that are coming. Michelle, I suppose from your perspective around all those frameworks and maybe some of the risks and things that we have to think through. And perhaps also around, we think they're going to converge, we're going to have less of these, or we're going to have more of these. And what sort of advice are you giving to your clients?
Try and answer that, Rob. Can you hear me? It's yes. I don't know if, okay. So I think we are really at a tipping point now when it comes to regulation and how key stakeholders are responding to this. I think to date we've seen regulation which has been broadly aimed at disclosure and almost a tick the box approach to have you done this, have you disclosed that. We're now getting to regulation, particularly with areas like TPT, where that regulation is becoming more nuanced and more focused, and it is aimed at driving through proper transition. It's not just tick the box compliance, it's really trying to drive through a sustainability transition within an organisation. And with that kind of regulation, and there are other kinds around Europe as well, comes greater exposure for an organisation. And I don't want to be the mistress of doom, but it's very, very clear that if you have a plan that is going to be revealed to the market and to key stakeholders, and you fail to deliver on that plan or update your key stakeholders appropriately when the dynamics change and your plan has to change, and those stakeholders can show that they relied on what was in that plan to their detriment, then where there's blame, there's a claim, I'm afraid. And as lawyers, we are expecting an increase in disputes around this. Now, the kinds of organisations that probably are least likely to litigate are those that are pricing risks. So your banks and your insurance companies, they're probably going to come back and ask for an amendment of the terms of their engagement with the organisation. It's not, they're not going to cut off their noses to spite their face through litigation. But we certainly expect to see other litigation, particularly possibly with customers in the and those that are involved in the supply chain, who have relied on some of these plans beyond the contract terms to their detriment, and they then may be able to show that they've suffered a loss and bring a claim. So those are the sort of real economy litigants. But of course, with shareholder activists, this kind of regulation and requirement to disclose really creates a real fertile ground or basis for them to take action. So we do expect there to be quite a lot more activity. In terms of convergence, my gosh, I don't know. I would hope that as the regulation becomes clearer about what it's trying to achieve, that we will start to see less of it, because it will become more refined and more effective. And without a doubt, I mean, this happens in many, many other areas. For example, anti-bribery and anti-corruption regulation, you do see a convergence. But what we say to our clients pretty, obviously, is comply with the highest standard. And just use that standard for your global operations. But without a doubt, we will probably see a geographical convergence, but whether we'll see less regulation, I don't know. I would just hope that it becomes more focused and relevant to organisations. I think we'll live and learn what hasn't worked and what hasn't been appropriate.
Yes, I tend to agree. I think we'll be in that world for quite some time. And Laurie, to pick one of your favourite phrases, regulation is a lagging indicator. So again, we say to our clients, you have to comply, but you shouldn't be driving your strategy through compliance. You should have clear strategy which puts you well ahead of any compliance requirements. Ben, I might just move around up to top left on our little 4-box model, another framework. We love our frameworks. And Ben, maybe around finance functions and businesses have been run very much on financial decisions, internal rate of returns, business cases that are predominantly about numbers, about pounds and dollars. But obviously now we're having to make decisions based on a different range of inputs. How are finance functions, how do businesses adapt, and how are they going to have to change to start making decisions and resource allocation in different ways using different inputs?
Yeah, it's a really good question. The first news is good news, which is businesses have been looking at non-financial measures for a very, very long time. The size of your market, how many customers you've got, your net promoter score, whether your employees have a positive experience of working with your company. So it's not a completely alien thing. We're not completely driven by money, but it's absolutely true that how you attach value and introduce sustainability and ESG considerations into the decision-making process is difficult. It's challenging, and how do you make the right trade-offs? And I guess the way that we look at it is from, I guess, the big decisions, the strategic decisions that a business makes, and how does it go about allocating capital and introducing ESG and sustainability measures and targets into that process, which is typically a 5-year plan, an annual budget, and then sort of quarterly forecast, those sort of things. So how do you do that? And I think it's being done with varying degrees of success. So things like carbon, you can start measuring. There are measures to do with carbon. You can introduce those things. You can actually quantify and value them, and you can introduce those into the decision-making process pretty easily.
We've just done that in our business, haven't we? We've just put carbon budgets into our business, which hasn't been easy, but you can do it. I mean, it's achievable and companies can get there.
Yeah, so if you're wanting to invest in a particular part of your business, you look at the financial return and you look at the impact on carbon emissions, and you can make some sort of value judgment and trade-off around that. At least be able to compare decisions at a strategic level in a consistent way. It might be consistently wrong, but it's still consistent. I think the interesting thing that's happening in finance is how do you embed these considerations into the day-to-day business as usual decisions that the business makes when there isn't a board overseeing that decision. The decisions are being made on the ground by people in the business, and that's kind of a fun area because that really is new. So one of the consumer products businesses that we work with has got you'll be familiar with, I guess, the terminology. It's a sales and operational plan that it runs every month. It combines what your sales force are looking to do with what your supply chain and manufacturing can make and can deliver with your logistics, and that sort of all ties together into a nice monthly plan of what you're going to make and who you're going to deliver it to. And this organisation has just started to introduce the idea of carbon into that decision-making process. So if you make a decision about what products I'm going to promote and sell this month, the decision about how much carbon impact that has kind of pops out of the system that they've designed. So they said, right, I'm going to invest in product A, I'm going to sell it to this customer, and I'm going to make it in this factory. The financial return is X, and the carbon impact is Y, and you can compare that to all your different alternatives and make a decision. So that's kind of neat, but it's the very start or starting point of how do you start embedding these considerations into day-to-day decision making. I think what we're seeing in the finance function is it going from something that's happening to other people somewhere else in the business to something that's actually trying to get embedded into the day-to-day jobs and decision-making of people in the business. And why is finance important? It's because finance is at the table in those decisions, kind of forcing discipline around finance and potentially forcing discipline about sustainability and ESG at the same time. But it's new. It's pretty recent thinking that we're seeing being used in different companies.
So how do you get started on that journey then? Because I suppose it's quite daunting to start looking at all the different parts of your business and then how are we going to bring in and improve our decision making based on those inputs. I mean, you gave an example there of an organisation. Is it start small? Where do you see this working well, and who's doing it well, and why?
So, it's a great question, Rob. And I might defer to Andrew in a minute. So just warning Andrew before to warm himself up. So I think it starts with being clear about what you're measuring. So what outcomes are you trying to achieve? What are the measures that you need to adhere to? What are the targets you need to set? And having that clearly laid out. So I mean, we are doing lots of work at the moment, and interestingly, it starts in the carbon intensive kind of extractive industries, but it's filtering down into other industries as well, where alongside your kind of annual budget and your set of targets, you've also got key non-financial, key ESG measures. So I think it starts with being really clear on what you're measuring, what targets are you setting, and then collecting good quality, high quality data to be able to analyse and assess. And that comes back to kind of what I was going to give the hospital pass to Andrew over, which is how on earth do you get high quality data in this area. So I think it starts with what you measure. Once you've got clear on that and you've lined it up to what your investors want and what your regulator wants, you can then start thinking about how you start embedding it in decision making. But if you've got no data, you really don't have a starting point. So I think the starting point is data, and that's where the fun and the problems start, I think. So if you look at finance and money, from the leather-bound ledger to sort of SAP S4, we've been collecting high quality data forever and ever and ever. It's kind of absolutely in the DNA of finance. It's pretty easy to do. You know, there's lots of discipline around it. It kind of gets done. If you look at this new data that you need, there's none of that muscle memory, none of that sort of coherence, consistency that you need to make kind of decisions. So it really starts with collecting high quality data and being really clear on your objectives, I think.
Spot on. So, Andrew, you probably tell I've gone off. Are they looking terrified because I've gone off script? I keep asking them questions. They're looking at me. Why are you asking me these questions, Rob? So you're terrified, Andrew? No. Ben's absolutely right? So we've got decades on decades of building processes, systems, controls, consolidation, reporting, assurance on financial data. And then we've got all this new data in our organizations. And to your point, Ben, I don't think we've got decades to build up all that infrastructure around it. So what are you seeing in the market, Andrew? And how, again, there's a lot of vendors out here today who have got solutions. There's a lot of development in this area. So it's quite a confusing landscape of, well, what are the steps I take to get moving on this? Because I know I've got to get more data. I know I've got to control it. So what are you seeing from that perspective?
Yeah, I guess I get to talk about the plumbing.
You get to talk about the plumbing.
Oh, okay. So, you know, I think we're moving past strategy, goal setting, targets. Of course, they could be better, but we're now heavily into the operationalization phase. And, you know, most organizations, let's be honest, have been doing it sort of a bit on a wing and a prayer, a little bit around Excel, as I mentioned earlier. And I saw a few nodding heads in the crowd around, you know, how organizations have been trying to manage this, right? And it is just, you know, forgive the pun, not sustainable, right? And I think and as Rob said, I mean, a lot of vendors around, but probably a lot of vendors in the rooms, around various kind of reporting applications. So I think a lot of organizations have gone down disclosures, reportings, whether you're on a Sphera, a Workiva, an Invisi, whatever it might be, at the front end. But I think with regulation, with people setting out audacious goals and targets, and then with regulation starting to become mandatory, we know CSRD, we've got the TPT sort of frameworks here, etc. You know, SEC about to put out something around climate disclosure. You know, it's starting to become very real around the quality of what you're reporting and the integrity. You know, so one is just on the compliance side is what's the integrity of the data and the data infrastructure and the process controls. And a lot of that data is not coming from our typical transactional work processes and controls. So we've got a massive upgrading just of the data lake, the data structure, the governance structures around that. But that then drives the performance improvement side of it. And of course, the conference here is all around net zero transformation. A lot of organizations put out some very big goals. The reporting applications are keeping score, but they're not driving the transformation. And as I say, a lot of organizations trying to, as a large consumer products company I work for, it's one of the major leaders in sustainability. Across their business units, multiple Excel spreadsheets, they're in 45 countries, multiple functions. They are trying to run all those initiatives and the carbon calculations through that sort of infrastructure. And that's just not going to work. And it won't survive the compliance, and it won't survive driving the business to where it needs to be. And so that digital net zero transformation platform, that sustainability platform, is the next big battleground I think every organization is going to need to upgrade in. Then the question is, do you go best of breed, or do you go with, a lot of CIOs really want to reuse the assets they have. So whether you're trying to use SAP or ServiceNow or use the Microsoft Cloud for Sustainability, Salesforce, but you know, I think there's a real balance between, you know, reusing what you have, and they're at a low maturity but rapidly developing, versus bolting on lots of best of breed. You know, for anyone who's best of breed vendor in the room, I think there's a role for all, but I think that architecture, most organizations are only just starting to invest in that fundamental architecture. They're going to need to operationalize this. And that's before we then get into every process, core process, whether it's planning and forecasting, budgeting, capital allocation, in the CFO office, or sustainable product lifecycle management for the MPD process, P2P, order to cash. All of those are going to have sustainability analytics built into them to drive the right behaviors, to drive the right outcomes. None of that is in place right now. So for all of us in the transformation space, this is an exciting opportunity because the catalyst for change is now. But navigating that systems architecture when it's evolving rapidly, just like digital industry 4.0 was, and how do you place the bet? I think the goal is that what's the flexible platform that you will evolve with your business that you can basically start to operationalize this and make it more efficient, cut cost, and have the integrity and authenticity of the information you're publishing externally.
If I can just build on a point there, coming back to your question to me around the financial services, at the moment we've just spoken about the real economy, whether it be industrials, extractives, or consumer products. So if we come back to the crucial role of the CFO and the importance of the institutional investor, everything that you've just said, data integrity, robustness of controls and so forth, is what the institutional investors are using to make their buy and sell decisions, but also that becomes part of their sector portfolio transition plans. So if there's a nuance, blooper, error, that affects not only the institutional investor, the asset manager, but then their client, the pension fund, and then ultimately society from a end beneficiary of all those investments. So I think there's also just an acknowledgement of the full value chain and the crucial element that the real economy sector-based companies play in getting it right. So I think just to make sure that there's that, we all recognize there is a domino effect when we do get it wrong, and likewise when we get it right.
So one of the things that we've talked about amongst ourselves is the interaction between the real economy corporate and its stakeholders, and the need to almost reverse engineer the plan, the operationalization of the plan, and everything else, so that it is meeting what the key stakeholders require. Are we seeing that? Are we actually seeing companies now really understanding what their key stakeholders need? And that could be institutional investors, it could be banks, it could be customers, NGOs, and actually starting to design their plan and their technology solutions so that they are compatible and are meeting the stakeholders' needs. I don't know, are you seeing that?
We are now holding everyone in the room back from drinks.
I know, exactly.
So why don't we bring this slightly to a close, but maybe I'll come to each one along the panel. We've got a bunch of people in the room. What advice we give them? What do they need to say to their CFO when they get back, either to the office or maybe the CFO's in the room, when they get back in the office, either tomorrow or on Friday? I'll start. I'll take the throne and then nick the best advice. I would mercilessly use and refer to the TPT, the transition plan. It's in the public domain. As I said, it's going through consultation. But what it does and what it allows is, and especially for people who are deep in the sustainability, deep in the net zero world, to use it to broadly engage the rest of your business around something that everyone has to take a pillar or take a part of and think about how it's going to impact their business. And so in terms of financial impacts, and again, I think this is quite handy because you're saying that actually everyone's struggling with this and it's okay that we're not perhaps where we need to be. So that would be my little bit of advice back to CFO. But Laurie, what's the one thing these people should be taking back to their CFOs?
Perhaps a curious question. So I would be asking my CFO for their degree of confidence in our ability to understand our investors' thematic priorities and expectations of us. So how confident are we that we know that and we can respond to it?
Back to Michelle's point around, do we know what our stakeholders are actually expecting of us yet? Yeah.
I think my question is, or what advice I give to the CFO is based on the fact that I think there's a fantastic leadership opportunity for CFOs to guide their business through this, and I think it's here forever. This is not a once and done thing. It's here together. So I think my advice is to go and ask your CFO how hard you want to lean in and what help they need. Because I think it's whichever way they face, there's a mountain of problems they've got to solve, and I think they need help. But I think in return, you'll get really strong leadership.
I would say what I am saying, which is don't compartmentalise sustainability. It has to be integrated and infiltrated throughout your entire organisation so that every single person understands where the risks are and how to access value. Stop boxing it in particular roles, just make it a part of business as usual.
And you're going to ask for budget for plumbing, aren't you?
I'm going to ask for the plumbing, yeah. No, I was going to say, with this CSRD, with TPT, etc., you're going to lose control of the narrative pretty quickly. You're going to be putting a lot more information out there, and you're going to be judged. It goes straight into the ratings, analyst formulas. If you don't understand the formulas, you don't understand that information you're putting out, it's going to drive scoring. What we have proved, we've taken thousands of companies, put it through our ESG quantitative application that we do for M&A valuation purposes. There is a correlation between your ESG rating scores and your financial performance. So my one thing is I think you need to take control, start setting up the infrastructure to drive the value narrative, drive the reporting the way you want to do it, and not be driven by a catch-up and a compliance approach.
Brilliant. Well, my fellow panel members, thank you very much. And thank you, everyone, for your attention to being here. And I do believe there are some drinks being served as we speak. We'll be hanging around for a bit, so any questions, please come and tap us up. Thanks very much.